Welcome back. This is Principles of Macroeconomics, and I am Liam Malloy coming to you from the University of Rhode Island. And this is the first video for Chapter 8. And in Chapter 8, we're going to discuss sort of things that can go wrong in macroeconomics, both in terms of multiple equilibria. So when we might have both a high equilibria and a low equilibrium and sort of a tipping point. And I think this was one of the things that came to light sort of in the Great Depression, where we ended up with a high unemployment equilibrium, which a lot of people at the time didn't think was really possible. But also, things like asset prices. And so when asset prices have a high equilibrium and then might get pushed into a lower equilibrium, that can have significant consequences, especially in the financial markets. We'll also in this video talk a little bit about sort of the difference between risk and uncertainty, where in risk you sort of know the potential outcomes and the probabilities of each potential outcome, whereas in uncertainty there are things you don't know, and when you don't know things, you can sort of expect what you have to be prepared for bad options. And all right, so I've got my slides here all set. Let's get started. So we can sort of think about this in terms of dynamics, right? Dynamics is really sort of moving from one equilibrium to another. And sometimes in economics, we don't talk about that enough, right? We talk about equilibrium, whether that's, a microeconomic equilibrium where supply is equal to demand, or a macroeconomic equilibrium where we're at our supply side equilibrium, we're at the natural rate of unemployment. But of course, a lot of economics, a lot of time is spent not in equilibrium, and so it's important to consider that. And of course, sometimes there might be situations where we don't get pushed back to the same equilibrium. So we will, in this video, we'll sort of do a brief introduction and then talk about some economic dynamics. Then we will go to use this model in thinking about housing booms and busts, right, which was the cause of the 2007, 2008, 2009 Great Recession. Then we'll think about sort of leverage and interconnection, and then we'll take our model and look at a little bit of environmental economics, especially looking at tipping points where we might move rapidly, not Hollywood style rapidly, but more quickly from one equilibrium to the other than we might expect. So sometimes these sort of very negative events or very unexpected events that you don't really model for, are called black swan events. That's what this picture is about. And so a black swan event is so rare and potentially so unknown that when you are modeling outcomes, when you're thinking about what are the potential outcomes, you don't even consider it. And if you don't consider it, then obviously your model is not complete and you can end up in a very bad outcome. So if we think about the 2008, 2009 Great Recession, we can see that the financial crisis that sort of happened in the fall of 2008 led to a big drop in GDP. So this is real GDP on our vertical axis. And then even after the end of the recession, right, which was sort of in mid 2009, we started growing again, but we didn't catch back up to our original trend line. And so if you think about it, all of this shaded area is lost output over time. And then obviously in 2020, we had the pandemic. Now, the interesting thing after the pandemic is that we did recover back to the trend line, the post sort of 2009 trend line. And so in that case, this sort of lost output is only this sort of bottom bit. And so that's what that's one of the things we want to think about, is like really what sort of happened here. Why was it so bad? And is there anything we can do about it to avoid it in the future? Now, the biggest problem with um, a financial crisis or a banking crisis is that the cause of the recession is when an asset price, which had gotten too high, right? So it had been a bubble, crashes. Now, that by itself is not the end of the world. You could argue that happened in the 2000 recession. We had a bubble in internet stock prices, and um, we still recovered fairly quickly. The problem comes when those assets are purchased with debt. And so in the 1929 stock market crash, a lot of those stocks had been purchased by debt. And in the 2008 financial crisis, housing, of course, is purchased by debt. And so what happens then is when the asset price falls, then people no longer have enough money to pay back that debt, and the value of that debt falls, right? So now the bank, remember, a bank's loans are on its asset side. And so if the value of those assets fall enough, then they become worth less than the liability side, and the banks go out of business. So in the Great Depression in 1930, 1931, we had thousands of bank failures. Now, the banks were much smaller back then. In the 2008, 2009 financial crisis, we basically went in and bailed out the banks. And so we'll talk about that as well. All right, so we'll first talk about sort of multiple equilibria, what that can mean. Then we're going to apply it to housing and environmental issues. And then finally, we'll talk about the difference between sort of risk and fundamental uncertainty. All right, so let's talk a little bit about economic dynamics. This can be complicated because once you start allowing your economic models to have multiple equilibrium, then it's not exactly clear which equilibria you will end up as. It's not always clear how you will move from one equilibria to another. So we're going to have a fairly simple model here, but don't take it as like this is the only way we could have multiple equilibria. All right, so when we talk about equilibrium in general, right, it's a really important idea in economics. The idea is that it's somehow self-perpetuating, that if we push the model in some way, that we will move back to a stable equilibrium. And so if we get a demand shock in macroeconomics, then wages go up, but then prices go up, and we move back to our supply side equilibrium. If we're in microeconomics and there's a demand shock, then we move up the supply curve and we get a new price that equilibrate that, so that quantity supplied is equal to quantity demanded. So often our disequilibrium, when we're not at our equilibrium, it's self-correcting, right? So there's incentives in the model, in the market, for buyers and sellers and firms and workers to change their actions and get us back into equilibrium. And that's why we say that this is self-perpetuating. But that's not always the case, right? And so, for example, we can look at housing. And with housing and frankly, with any asset, it's not always clear that there will be a mechanism that brings our prices and quantities back down. And so, for instance, if prices start to go up, we could say, all right, well, maybe that means that prices are going to come back down, but maybe it just means that prices are going to go up and we should expect higher prices in the future. And if we do expect higher prices, then that can be sort of self-perpetuating. And of course, homeowners have an incentive to try to keep housing prices high and therefore limit supply. And so that can be a problem as well. And so in this case, what we saw in the sort of 2000 to 2006 time frame in the United States, especially, but also in other countries, is sort of a general increase in prices so that people started to, sort of assume that prices can only go up. And then, of course, as we saw, that was not the case. But, prices did fall in the Great Recession, but now housing prices are even higher than they were back then. So if we want to think about sort of a stable versus an unstable equilibrium, this graph kind of gives us a good view of what that might mean, right? So if we're on the top of the hill and we push in either direction, the ball is going to roll down, right? And we're going to end up at a new equilibrium. So that equilibrium at the top of the hill, even though the ball is steady there, right, and it's not moving, if it gets a little push in either direction, it's going to go to a new equilibrium. Whereas if we're at the bottom of the hill, right, in this case, then giving it a little push left or right just brings it back. And so we can talk about this in terms of negative feedback and positive feedback. And I think sometimes these terms are a little bit confusing because negative sounds bad and positive sounds good. But that's not what we mean here. A positive feedback process basically means that if we push it to the right, it keeps going to the right. And so if we think about prices, that would mean if the price goes up, it keeps going up. And if the price goes down, it keeps going down. Whereas a negative feedback process means that if we increase the price, then the feedback process pushes it back down. If we decrease the price, then the negative feedback process pushes it back up. And so a negative feedback process is a stable equilibrium. That's what we have here at the bottom of the hill. Whereas a positive feedback process is an unstable or tipping point equilibrium. And so if we're at a tipping point equilibrium, then pushing it in either direction will get us to a new equilibrium. So this is sort of important to think about in terms of lots of economic processes, right? We'll talk about asset bubbles as well. But also it could be, things like a poverty trap where, if you have limited wealth, you don't want to lose that wealth. And so then you're very risk averse. And so you're much less likely to take risks that could potentially have big positive outcomes. So you invest instead in low yielding assets. You get a low return on those assets, which keeps your wealth limited, right? Whereas if we can think of the opposite as well, right? You have a lot of wealth. You're like, okay, well, I could afford to lose some of it, so I can take some risks. You take some risks. Some of them are successful, earn you a lot of money, and that just increases your wealth even further. All right. So we'll stop there, and then we'll sort of expand this model, this sort of tipping point with both unstable equilibrium and stable equilibria to the housing market and see if that helps explain sort of the asset bubble that we saw in the early 2000s.